All right. Today is Monday, January 17th, MLK Day. Hope everybody had a long, restful weekend. But let's be honest, by the look of it, you're still hungover. Your eyes are rolling all over the place, you're dazed and confused. You better sober up. And oh, by the way, close that nasty incognito tab that you have open while you're watching my show, because I got a good one for you tonight. And here it is, in focus. How about we talk about the bombshell that we got from JPMorgan on Friday? And then we have an update in our macro analysis, specifically when it comes to inflation. And lastly, earnings preview. You know how they say, don't worry about inflation. Don't worry about the Fed raising interest rates higher. The stock market is going to be fine, and the economy is going to be even better. And the reason is, inflation is going to go away. It's going to ease up once the supply chain catches up after the Pokemon variant or whatever other variant they're going to release on us is gone. And on top of that, the consumer is strong and flushed with cash. Matter of fact, JPMorgan CEO Jamie Dimon says the consumer's balance sheet is great, and therefore the economy is going to continue to grow. Don't worry about inflation. Don't worry about the stock market and raising interest rates. We'll be fine.
You know, you gotta, when you look at the economy, the consumer, okay, now there's all respect to the fact that it's not true for all consumers. There's some still suffering and we're still kind of working through this, but the consumer balance sheet has never been in better shape. They're spending 25% more today than pre-COVID. They've got $2 trillion in their checking accounts. They have the wherewithal to spend more. They paid down a lot of debt. Their debt service ratio is better than it's been since we've been keeping records for 50 years. Home prices are up, stock prices are up, jobs are plentiful, wages are going up.
The consumer is good, the economy is growing. We only have one problem here, and this problem is the thing. Once the thing is gone, the economy is going to be firing on all cylinders. Hot, 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 and the growth is still intact. Corporate earnings are great. Okay, here's the problem. The headline reads, JP Morgan's shares fall 6.4% following plan for big expense boost. So far, so good. Perhaps this is related to JP Morgan, not the stock market or the entirety of the economy. Hold your horses, because the devil is always in the details. JP Morgan Chase led as much as 6.4% after the company said compensation and other costs jumped in the fourth quarter ahead of an expected surge this year. We're talking about inflation now. Expenses are rising higher, not just in JP Morgan, but across the board. The question is, are revenues also moving higher? Wait for it. Expenses in the last 3 months of 2021 rose by 11% from a year earlier, and the firm said to expect them to rise to about $77 billion this year, excluding legal costs. And I say, how about not excluding legal costs? Because a criminal organization like JP Morgan, they need to pay a lot of lawyers. From stealing from clients, from robbing the elderly, from money laundering, to rigging the bond and commodities markets, and the list goes on and on and on. So yeah, expect JP Morgan's legal fees to also be inflated. And that $77 billion, by the way, would be an increase of an 8.6%. The forecast, along with worse than expected trading results, and muted loan growth, pushed the stock into the steepest decline since June 2020. So far, we have two bad things to look out for. Number one, expenses are crushing companies because inflation is rising higher. Number two, the trading revenue is down big. What does that mean? The mania in the stock market is coming down to an end because the majority of retail bought the hypermania stocks and they're now holding the bag. So the stock market is about to slow down dramatically. Continuing, JP Morgan's results were surprisingly weak and were hampered by uncharacteristically poor expense management. Octavio Marnizzi, whatever the hell his name is, the chief executive officer of consultancy Optimus, who cares. Here's the important part though. Octavio continues, and he says, the real surprise came in the 5% increase in non-interest expense, which looks difficult to justify. With all the criminal activities that JP Morgan is involved in, who knows? Yet the most obvious explanation of this is wage inflation. JP Morgan shares fall 5% after CFO lowers guidance on headwinds, quote unquote, including wage inflation. What are they talking about here? And pay attention now, because the narrative out there says we're about to see the roaring 20s, the boom times. Really? We're going to have a boom with banks and not performing? Listen to this. CFO Jeremy Barnum told reporters on a conference call that management expected headwinds, quote unquote, of higher expenses and moderating Wall Street revenue to cause the company's returns to dip from recent years. That means it is likely the bank will miss on the firm's 17% target for returns on capital, he said. He also added, over the next 1 to 2 years, we expect to earn modestly below the target as the headwinds likely exceed the tailwinds. End quote. Wow. Adding that the goal is still valid over the medium term, quote unquote. When asked if a tight labor market was forcing JPMorgan to pay its personnel more, Barnum had this response. It is true that the labor markets are tight, that there is a little bit of labor inflation, what you think? And it is important for us to attract and retain the best talent and pay competitively according to performance. And this is according to Barnum. Nevertheless, the bank will benefit from rising interest rates and loan growth that have attracted investors to the financial industry in recent months. Net interest income is likely to hit roughly $50 billion this year, a gain of $5.5 billion from 2021, on the anticipated rates and high single-digit quote-unquote loan growth, Barnum said. And I say this is all bullshit, Mr. Barnum. You know it, and I know it, because, yes, the change in the yield curve, this is the assumption that the Fed will raise interest rates and the 2-year will pay more than the 10, and this will be good for banks, meaning that the yield curve will be steep. That is the assumption. The problem is, what if the yield curve flattens, if not even inverts? That's number one. Number two, you keep saying that expenses are rising higher. Inflation is killing us. And oh, by the way, the stock market mania is coming to an end, because the trading revenue is down big. But keep your hopes high, because our interest rate revenue, our loan revenues, will compensate for all of that. And I say, who the hell is going to take out loans when interest rates are rising higher? And oh, by the way, the economy is slowing down dramatically. And the Fed is about to raise interest rates. That's the double whammy on the economy right now, which will guarantee a market crash and a collapsing economy. Who is going to take out loans? You and I know. Companies, the rich, insiders already took all kind of loans they need. Billions and billions, if not trillions of dollars. And they secured all of these loans at pretty much zero interest rate, meaning that the rich are already locked and loaded, and they're going to scoop all of these assets and properties and stocks once they crash at a cheaper price. The problem is, you will find out that the economy is not going to perform with only the rich doing good, while the poor, the middle class, small businesses already crushed. Who is going to take out loans when growth is stagnant in the economy? Continuing, government stimulus programs during the pandemic left consumers and businesses flush, resulting in stagnant loan growth and prompting Diamond to say last year that loan growth was quote-unquote challenged. But analysts pointed to a rebound in the fourth quarter, driven by demand from corporations and credit card borrowers. Here's the problem. We already covered the consumer, the suicidal nature by the consumer of swiping those credit cards up and down, up and down, up and down in the fourth quarter to keep up with inflation during the holidays spending season. Perhaps what Mr. Diamond is not telling you is the fact that the consumer will slow down dramatically. They've already exhausted their stimmies, they've exhausted their savings, now they're swiping those credit cards up and down, up and down. But once the economy sours, and this is already happening by the way, the spending will go down. You will see this in the retail sales data that I'm about to cover for you. The consumer is already maxed out, and now they've lost their jobs, and oh, by the way, they're in debt from all of that spending. What is going to happen here? Is the government about to bail out our credit card debt? And if the consumer is about to slow down dramatically, and the spending is about to recede, then corporations will not have the incentive to take out loans to expand. Matter of fact, they will contract to capital preservation mode. What does that mean? It means managing their expenses by lowering costs. You do that by getting rid of employees, not taking out loans and expanding more. You get rid of employees, you get rid of excess spending to preserve capital, specifically as we head to monetary tightening. And I know some of you wise asses in the comments going to say, well, all of what you're saying right now points out to inflation going down because the consumer is going to stop spending, the economy will stagnate, and therefore inflation will go down. You gotta be careful here. You and I know inflation will go down sooner or later. The problem is it gonna go down for the good reasons for the bad ones. That is point number one. Point number two. What if inflation sticks? We've seen that before. And this inflation is indeed looking sticky, which will result in a stagflation phenomenon. Anyhow, JPMorgan's Chief Operating Officer Daniel Pinto said last month during a conference that fourth quarter trading revenue was headed for a 10% drop, driven by a decline in fixed income activity from record levels. However, trading revenue slowed slightly more than that, dropping 11% to $5.3 billion in the quarter, the bank said. That was driven largely by a slowdown on bond trading desks. Investment banking helped with a 37% jump in fees. You're supposed to expand organically, not by increasing fees. JP Morgan, this is another sign for trouble here. The bank was forced to pay $200 million in fines last month to settle charges that its Wall Street division allowed workers to use messaging apps to circumvent record-keeping laws. And this is not new for JP Morgan. Pretty much every single quarter we get a massive fee. Hundreds of millions of dollars. Because after all, JP Morgan is indeed a criminal organization. The difference is, for JP Morgan, they pay fines as a punishment for their crimes. But if you and I commit the same crimes, we're going to jail for a long, long time. JP Morgan boss, top criminal, and CCP apologist Jamie Dimon. Well, he says the wage inflation has arrived in a big way, and we shouldn't be crybabies about it. Mr. Dimon says that he will pay whatever it takes for JP Morgan to win Wall Street's war for talent. Apparently, there's a war for talent over at Wall Street. Goldman Sachs is treating their employees like shit, except the top, of course. And now all of a sudden, they're all realizing that there's a war of talent and they gotta pay more to keep their employees. And before you say perhaps the boost in expenses for JP Morgan is exclusive to them because they're spending more to beat the fintech industry. Perhaps, but probably not, because here's another one. Citigroup shares slide after fourth quarter profit declines 26%. Once again, And my boss Diamond says, forget about 4 interest rate hikes. I said that before. Make that about 7 rate hikes in 2022 alone. You know what that would do to the stock market? Cue the nuclear bomb. That's what's going to happen. And when we speak about interest rates rising higher, take a look at this. U.S. loan funds post the biggest inflow since 2013 as the Fed eyes hikes. Now, the loan funds move higher when we are anticipating higher interest rates because it is good for banks, it is good for lenders. On paper, of course. This is the biggest inflow since 2013. The taper tantrum. And of course, market bulls would say, you see what happened back in 2013? Everybody panicked. Tapering is about to happen. They're about to raise interest rates. And what do you know? The Fed backed off. And in 2018, Jerome Powell said the same thing. He's going to raise interest rates. And he backed off. The moment the market crashed, about 20% or so. So forget about it this time. The Fed is bluffing. They will never raise interest rates. They have our best interest in mind. Okay, but here's the problem. Back in 2013, we did not have inflation, the same magnitude that we're having right now. Here are some household items that we have. And look at this inflation. Eggs up almost 21%. Beef up 15%. Bacon up almost 24%. Ground beef up almost 14%. Pork chops 7.5%. Oranges 9%. Boneless chicken breast 13%, milk 6%, coffee almost 10% increase year over year. Hey geniuses, we have an election coming in 2022 this year in the fall. You really think that the administration is not going to coordinate with the Fed to tame down this inflation by whatever mean is necessary so we can win the elections? Think again. I know, but the Fed is independent and they're never going to coordinate with the White House. Okay. Here's the headline, and this is from Frank Luntz, who's a pollster, but he also would have been a better spokesman for Subway than Jared. But anyhow, he says this country is getting angry when they go to the supermarket, and the Democrats are going to be crushed in November. So once again, do you really think that the Fed is not going to raise interest rates higher? Think again. The UN Global Food Prices Index hit the highest since 2011. And back then, when food prices were surging out of whack, that produced the Arab Spring, a massive destabilization in one of the most important geopolitical regions in the world. We're already seeing the destabilization happening right now. The unrest in Kazakhstan, that was due to petroleum petroleum prices moving higher. We're seeing the tensions between Russia, Ukraine, the US, and the European Union caught in the middle. We're seeing what's going on in Turkey, for example. That country's economy is about to collapse. And what's going to happen next? We're seeing North Korea facing massive starvation crisis right now. And we have more sanctions on North Korea. And they're firing missiles. Their people are starving. Food prices are surging out of whack. Whatever the Fed does can cause massive destabilization in the globe from a geopolitical perspective. Nobody talks about it from that scope ever. But when you trace the origins of these conflicts and these massive unrests, you always find an economic reason, and in this case, it is inflation. When we talk about the macroeconomics outlook, if the economy is hot, growth is intact, corporate fundamentals are great, the consumer is so strong and flush with cash, then why aren't you people happy right now? You're not, because in reality, the picture is different, and therefore, U.S. consumer sentiment sours in early January to the second lowest level in a decade. Take a look at this. Unbelievable. As inflation expectations rise higher, consumer sentiment falls down. And maybe the argument here is the consumer has no other choice but to use credit cards to keep pace with this inflation. They ran out of stimulus, they exhausted their savings, they're not earning enough to keep up with this inflation, so they have to swap those credit cards up and down, up and down. And this is a recipe for an upcoming epic disaster in this economy. When interest rates start to rise higher, economy sours, we start to see job losses, and a lot of these unemployed folks will have a lot of debt that they have to pay. What is going to happen then? And here's another one, another bad sign for this economy. U.S. retail sales dropped by 1.9% in December as the Pokemon on inflation surged. Sales grew by 16.9% last year on strong consumer demand. Now, this is not a surprise because the majority of consumers already front-loaded their spending in October and November. This behavior was done to avoid shortages and buy goods, gifts, items before prices start to move higher. So the consumer is chasing inflation. This is not a good sign. And notice what's going on here. Retail sales down for December, yet the CPI inflation data came out hot in December. So you have economic activity slowing down, retail spending versus inflation moving higher. What does that mean? Stagflation, baby. You might say, hey, but I'm not going to go do shopping in retail businesses. That's too much with the Pokemon and all of that. I buy online from Amazon. You're lying, bro. It's all about the FUD in this channel. Consumer spending is still intact. Look at online sales. Here's the problem, though. Your packages, well, they're not arriving, are they? And here's the reason. We are seeing an unbelievable wave of crime in the state of California, courtesy of Governor Kim Jong-un Newsom, who's absolutely the worst governor we've ever had. We had quite lousy ones in the past. But crime is running rampant in this state, and of course they're stealing packages from trains. All of these Amazon packages, they're being stolen all over the place. And look at these images. Empty boxes, empty packages as far as the eye can see. Matter of fact, all of these packages got stolen. The thieves, of course, are reselling these items that were inside the package in the black market. But they stole so much. There were so many boxes and packages covering the tracks to the point where the train went off its tracks. Unbelievable stuff. And this is, of course, once again, courtesy of the third world state that we call California. Here's the thing when it comes to inflation, though. I'll give you the good news first, and then I'll give you the bad. Here's the good news. Perhaps inflation, specifically food inflation, will slow down because U.S. fertilizer prices are also easing. When you look at the index, it is pretty much closer to all-time highs, but it is easing. It is slowing down. It is dipping. Is it going to move higher again? Who knows? In the meantime, from watching natural gas prices, it is likely to move higher again. But this is the extent of the good news that I have for you. Here comes the bad. What if what we're seeing right now is a stagnant economy facing a white-hot inflation? Economic activities are slowing down across the board, but prices remain high. Commodities continue to be bought. Every dip is being bought. So what if what we're seeing right now is a stagflation phenomenon? Matter of fact, Jeffrey Gundlach, he sees recessionary pressure building with inflation. And he could be right. Take, for example, U.S. factory output. The headline reading was down, surprisingly so, but the drop was due to shortages. So we're seeing a slowdown in economic activity, yet prices remain high, shortages remain in place, wage inflation continues to move higher. Not good, folks. Not good. Another one. When we talk about metals, stockpiles, they're tightening. The supplies are nowhere to be found. Look at aluminum, for example. Supplies nowhere to be found. Demand remains sky high. This is the everything metal. We have a boom in EV manufacturing, for example. Every country wants to take advantage of lower interest rates before they move higher by doing infrastructure spending. Well, they need a lot of aluminum. The demand is sky high. The supply is nowhere to be found. And therefore, aluminum prices continue to move higher and higher and higher. And if that wasn't enough, what about diesel costs? They're moving higher. Trucking, farming, heating will get more costly as diesel surges. And look at that. There was a dip. It got bought, and now diesel fuel prices are moving higher. Who's to say we're not going to see the same with fertilizer prices? They're dipping right now. Perhaps they will get bought, and here we go again. Inflation going higher with no stop in sight at all. And what about wage inflation? Perhaps that's stopping. Perhaps we're reaching a peak here when it comes to wage inflation. Not really. We're just getting started here, baby, when it comes to wage inflation, because the mentality has changed dramatically. We're not going to go back to starvation wages here. Not going to happen. And you are seeing this beforehand in Starbucks stores. Starbucks as a company prides itself as being progressive and pro-labor, yada, yada, yada. Workers are taking advantage of that by saying if you want to be pro-worker, you want to put your money where your mouth is, then you should be accepting unionization, meaning higher wages, higher benefits, which will mean higher costs for you and I, the end consumer. Perhaps by having higher costs, we will move to other competitors of Starbucks, or maybe drinking coffee at home, which could end up hurting Starbucks as a company. And this will happen across many other companies, perhaps all of them, because when you have one company unionizing and having its labor paid a little more, with this labor shortage that we're having right now, if you are a competitor to Starbucks, you might say, okay, Starbucks will raise prices to pay their employees higher wages. That's good to me. The problem is, how are you going to find workers when Starbucks is paying more? The expectations are now anchored higher when it comes to wages. Employees are expecting more, not less. Your employees are not going to be happy working at your crappy shop when across the street, these labor union workers at Starbucks are getting paid more. See what I'm saying here? In all likelihood, we will see more and more and more wage inflation. Perhaps companies will say, okay, we'll pay you more, but no unionization. Either way, wages are going to go higher. And to compensate for these higher wages, corporations will pass the extra cost to you and I, the consumer. What about the chip shortage? Maybe we can find some relief here because a lot of you say this is a supply chain problem. Inflation is a supply problem. Once the virus is gone and the supply is ramped up again, inflation will be gone. Here's the problem. Inflation is not going to go down when you have such massive demand, and a lot of that demand is already accounted for, and the supply, whatever they're working on right now, is to catch up with demand from last year. So if you ramp up the supply, you're only catching up with demand from a year ago, yet you're getting more and more and more demand. You're still going to be behind the curve here. And by the way, expanding supply is not easy. Intel picked Columbus, for example, for a $20 billion semiconductor factory, and they're planning to employ 3,000 workers. That's going to take time. It's going to take money. And by the time the factory is kicking and running, who's to say the economy is not going to slow down dramatically? And now you have the inverse phenomenon. Supply is high, but demand is nowhere to be found, which means that this factory will be a bust. In the meantime, while this factory is being built, inflation is also being built higher and higher and higher. Maybe at some point it's going to crash, but this is not an immediate solution to this inflation crisis. The immediate solution is curbing down the out-of-control demand. You can only do that by tightening the monetary policy aggressively and raising interest rates higher. There is a cost to that. It's going to crash the market. It's going to slow down the economy dramatically, perhaps push us into a recession. But the other choice is to wait for the factory to open 2 years, 3 years from now. In the meantime, inflation perhaps morphs into a hyperinflation crisis or becomes so large to crash the economy and the stock market. By the time the factory is built, it's no longer needed because the demand is dead. But rest assured, you have some allies here. The King of Doves, New York Fed President Williams, and he says inflation will cool down to our target of 2.5% by the end of the year. Here's the catch. Williams says that inflation will cool down due to the bad reasons, due to a massive slowdown in growth. He's playing mental gymnastics here because, yes, inflation will cool down to 2.5% by the end of the year, maybe, but why? He says a slowdown in growth. What would cause that slowdown in growth? Is it the Fed raising interest rates higher, Mr. Williams? And perhaps we should listen to Dr. Doom from the 1970s, Henry Kaufman, who blasted Powell on inflation, and he added that the Fed chair lacks the stamina, quote unquote, to tame prices. And I say, look at Jerome Powell. Stamina is the last thing I would think this guy has. And lastly, let's move on to earnings preview. On Tuesday, meaning tomorrow, we have Bank of America, Goldman Sachs, and Charles Schwab. The risk is to the downside when it comes to all of these banks. And the most important earnings, of course, will come from Bank of America because we have to confirm whether JPMorgan and Citibank were the outlier, the exception, or is the dramatic slowdown in growth and higher expenses rampant throughout the industry. I'm also looking at Goldman Sachs because it is a stock that I own, and I think that the risk is to the downside. If trading revenues are down, then Goldman Sachs will get hit dramatically, and therefore I have puts ahead of time. Wednesday, we have United Airlines, United Healthcare, Procter & Gamble, Alcoa, U.S. Bank, and Morgan Stanley. When it comes to Morgan Stanley, whatever results they report, not going to be surprised when you have Goldman Sachs report. If we have a massive slowdown in trading revenues, it will hit Morgan Stanley too. U.S. Bank, that remains the big question when it comes to banks. I own the stock. Everybody says interest rates are moving higher, you got to buy financials. But do you buy the big banks, like JPMorgan, for example, or do you buy the regional, smaller banks like U.S. Bancorp? The contrast between the results from Bank of America, for example, and U.S. Bank will answer this question for us. When it comes to Procter & Gamble, the question is, they're raising prices higher. What do they see when it comes to inflation, the supply chain woes, the shortages? Are they about to raise prices even higher? Is the consumer still receptive to higher prices? And therefore, Procter & Gamble's report will be extremely important. Alcoa, another important report. We know there is a shortage of aluminum, but Alcoa will let us know where the demand is. If the demand is slowing down, it will be bad news for Alcoa. United Healthcare, you and I know the story. Humana crashed all of these stocks last week. The administration want all of these insurance companies to pay for COVID testing for free. I don't see good things happening here for UNH. I think the stock will go down, absent of a surprise, a pleasant surprise. And that dip will be worthy of considering to buy. We have to look at the results and the outlook before we make that decision. When it comes to United Airlines, it was a hot season. The fourth quarter was a hot season. Prices were sky high. But we had a lot of cancellations, number one. Number two, fuel prices went down in December, but they were high in October and November. And now fuel prices are moving higher again. If this quarter's results are not impressive throughout the airlines industry, then you gotta run for the hills when it comes to airlines because they face two major headwinds. Number one, jet fuel prices. Number two, the balance sheets are not good. The zombie companies drowned in debt. If interest rates move higher, it's going to be a problem for airlines. So this quarter's result better be pristine for United and American and the rest of them. Speaking of American, on Thursday we have American Airlines. We also have Union Pacific and Netflix. When it comes to Union Pacific, it is an inflationary stock. They can charge whatever they want to charge. Yes, their input costs are moving higher, from labor to fuel, but they have the ability to pass that extra cost to whoever using their services, and whoever that is, they're going to pass the extra cost that they just paid Union Pacific down to us, the end consumer. So it is an inflationary stock, which makes this report highly important to the outlook of inflation. And lastly, we have Netflix. Netflix on Friday quietly announced price hikes, and this is quite peculiar, the timing of this news coming out 1 week before the report's out. Is Netflix distracting here? Are they trying to pump the stock higher before we get a massive negative surprise from Netflix that perhaps subscribers are leaving or expenses are rising so high while their revenues are still stagnant? Who knows? Why would you release a good piece of news that would have popped the stock higher after the report ahead of time? Why would you do that? Something is fishy here. Usually companies would leak the bad news ahead of time to have that priced in when the report comes out. But this move is quite peculiar here from Netflix. Anyhow, folks, let's move on to the market's information, starting with the performance of the market last week. And here we go! The Dow Industrial Average on Friday was down 201.81 points, or a decline of 0.56%. The Nasdaq was actually up by 86.94 points, or a gain of 0.59%. The S&P 500 pretty much in the flat line, yet closing in the green with a modest gain of 3.82 points, or 0.08%. What about the sector's performance on Friday, leading the pack at number 1 and capturing the gold medal, energy? At number 2 for the silver, technology. Number 3 for the bronze, communication services. The laggards of the day on Friday were REITs, industrials, and materials. Let's contrast that with the performance for the week, leading the pack by far, capturing the gold, silver, and bronze, energy. And the laggards, once again, REITs, utilities, and consumer cyclicals. What about the advance to decline ratios on Friday? NYSE, 45% advancing versus 52%. Declining. The Nasdaq 47% advancing versus 47% declining. Lots of short covering on Friday in anticipation of the long holiday. We have a shortened trading week this week, and therefore the bias, the path of least resistance, is to the upside. This is the assumption. It doesn't mean it will happen. What about futures? Moving on. On Friday, massive pops for energy futures, specifically the WTI and Brent, both gaining over 2% apiece. The WTI moved higher by more than 2.5% on Friday alone. Gasoline was up, heating oil was up, yet natural gas took another hit of 1% or so on Friday. Now, the most immediate issue when it comes to energy prices, specifically natural gas, is the tensions between Russia and Ukraine. And it appears, it's going to happen at this point. The headline reads, Russia could use failed talks with US and NATO as pretext for invading Ukraine, experts and officials warn. And we also saw a massive cyber attack against Ukraine, warning the population to expect the worst as tensions with Russia rise. The question is, was it the Russians behind the cyber attack, or was it us, warning the Ukrainian population that's going to happen and we're not going to have your back? And boy, that will cause a massive explosion in natural gas futures. What about softs? What's going on here? Modest declines for lumber and OJ, yet we have big gains led by cocoa, cotton, sugar, and coffee. Even sugar is rising higher. Perhaps we're bottoming here in sugar. Watch out for that. What's going on with metals? Not so good. Muted activities for gold, silver, platinum, palladium, all pretty much in the flat line, although silver lost almost 1% on Friday. The biggest loser here is copper. Copper is down over 2.5%. The dollar moved higher on Friday, and copper has the highest degree of sensitivity to the US dollar. What about meats? What's going on here? Modest gains for live cattle futures and modest losses for feeder cattle futures. Yet lean hogs, the new big tech, is soaring higher, gaining almost 4% on Friday alone. And I got some bad news for you here. Pork cut prices are at the highest level since 2012. Now, is this a supply problem? Not really, because when you look at lean hogs futures, they're not at the moon. They went down dramatically. And the reason is we have the Chinese hog herd already recovered all of the losses from the African swine fever. The problem we have here in the US with pork prices soaring out of whack is the fact that we have workers calling out sick in the processing plants for meats, but specifically pork. Now, this is an example of a transitory inflation because the workers will test negative. They will come back to work after the quarantining is done. The problem is there is a gap between demand and supply. You can solve that by two ways. Either the workers have to work extra hard, put in extra hours to catch up with the demand because the demand did not slow down, or that gap will continue to stay and workers will have to catch up with that demand, that gap, pretty much every single day, and that will add more pressure to push pork and hog prices higher here in the United States. That leads us once again, we have a massive demand problem. The demand has to slow down at least because we have multiple factors impacting supply negatively. What about grains? What's going on here? We have muted action across the board for soybeans, wheat. On the other hand, massive gains. Look at canola, for example, leading the gains with over 3.5% on Friday alone. We also saw gains in rough rice and corn futures. On the other hand, we have losses for oats. This channel called the top in oats spot on, at least for now, and oats is trading negatively, losing almost 2% on Friday alone. Moving on to the big casino, the options market. What's going on here? On Friday, the hottest table by far, well, not by far, but it remains the hottest table, is Apple. With about 1.2 million contracts traded hands on Friday, about 55% of those were calls. At number 2, Tesla, the souffle. With almost 1.2 million contracts traded on Friday, about 50% of those were calls. So we have 50-50 action on Tesla. They're buying a lot of puts, folks. And here it is, number 3, AMD. With almost 500,000 contracts, about 57% of those were calls. What about the unusual activities that took place in the options market today, on Friday? We had a lot of them. How about the ticker FTCH for Farfetch? They're buying calls here, the $30 calls for the expiration date, March 18th, with the expectations that the name could pop higher by more than 10% by then. They paid about $2 a piece to enter this trade, all in all spending about $5.2 million. What about the trade for the ticker TQQQ? This is the leverage index for the NASDAQ, the triple Qs, which happens to be popular by the retail crowd. So we know retail is buying the TQQs and they're betting for a rebound here in technology in what it's about to be a shortened trading week, and backs are not performing. So perhaps we will see some buying of the dip in the big caps as quote-unquote safety. They're buying these 78 calls for the expiration date this upcoming Friday, January 21st, with expectations that the name could pop higher by more than 8.5% by then. They paid about 35 cents a piece to enter this trade, all in all spending about $580,000. What about the trade for the ticker SPY for the S&P 500? They're buying puts here, the 432 puts for the expiration date, February 11th, with expectations that the SPY could drop down by more than 7% by then. They paid about $2 a piece to enter this trade, all in all spending about $2.8 million. What about the trade for the ticker XLF? This is the financial ETF. They're buying the 37 puts. After the JPMorgan results, they're betting that financials will go down, meaning Bank of America, Goldman, Schwab, Morgan Stanley will all disappoint. In this case, they bought the 37 puts for the expiration date, April 14th, with expectations that the XLF could drop down by more than 9% by then. And this could be a protection/insurance trade for somebody who's long the XLF. Anyhow, they paid about 70 cents a piece to enter this trade, all in all spending about $700,000. What about the trade for the ticker IWM for the Russell 2000? They're buying puts here, the 175 puts for the expiration date, April 14th, with expectations that the IWM will crash by more than 18% by then. They paid about $1.80 a piece to enter this trade, all in all spending about $1.8 million. What about the trade for the ticker MQ Marketa? Not doing so hot, so down big from the top, but somebody's buying the dip here. What dip? Somebody's buying the crash. Betting for a rebound, buying the $15 calls for the expiration date, February 18th, with expectations that the name could rebound higher by more than 9.5% by then. They paid about $1 a piece to enter this trade, all in all spending about $850,000. And here it is, apes. What about AMC? Buying puts, unfortunately for you, the 16 puts for the expiration date, March 18th, with expectations that AMC will crash by more than 22% by then. They paid about $2 a piece to enter this trade, all in all spending about $1.6 million. And what about the trade for the ticker XLE? This is the energy ETF. They're betting for more upside here in oil, specifically the XLE, by buying the 73 calls for the expiration date March 18th, with expectations that the XLE could pop higher by more than 13% by then. They paid about 70 cents a piece to enter this trade, all in all spending about $500,000. What about the ticker YNDX? This is a Russian tech company. It appears that it already topped, and it is trading down. We have a lot of problems here with the Russian economy and the tensions between Russia and Ukraine, perhaps more aggressive sanctions to come here. So they're buying puts, the $40 puts for the expiration date, March 18th, with expectations that the name could drop down by more than 23.5% by then. They paid about $1.50 a piece to enter this trade, all in all spending about $850,000. Continuing, what about the trades for the ticker XRT? This is a put spread. They're buying the 75 puts and they're selling the 65, all for the expiration date February 18th, with expectations that the XRT will drop down by more than 10%, but not more than 22% by then. And this is a bearish bet against retail. Retail is not going to do so hot so right now. Retail sales are down. The peak of spending is already here. Anyhow, they paid about $1 a piece for the 75 puts, and they received about 50 cents a piece for the 65 puts, all in all spending about 50 cents a piece, and this brought the total all the way to about $250,000. Now, what about the ticker SPG? Here's another way to bet against retail businesses besides the XRT. This is for Simon Properties. They're buying the 140 puts for the expiration date, February 18th, with expectations that the name could drop down by more than 10% by then. They paid about $2 a piece to enter this trade, all in all spending about $1 million. Lastly, what about the trade for the ticker ARKK or ARK Invest for our favorite Tesla witch, Cathie Wood? They're piling in here, the shorties. They're buying the 76 puts for the expiration date, February 18th, with expectations the name could drop down by more than 5% by then. They paid about $3.50 a piece to enter this trade, all in all spending about $1.8 million. Moving on to the heat map analysis, what's going on here? This is the heat map on Friday. As you can see, energy is still consistently performing. And therefore, all the bullish bets are happening in energy. It continues to perform consistently so. Unlike financials, for example, they got hit. The cyclicals got hit. Defensives, utilities, industrials, materials all got hit. Yet we also saw buying of the dip combined with short covering in the big caps and certain high valuation names in the software sector of the market. Another consistent outperformer is the value pocket in chips. We're talking about AMAT, we're talking about Lam, we're talking about ASML, we're talking about Micron, Qualcomm, Intel, Texas, all outperforming. But we also saw outperformance from AMD and NVIDIA, the high multiple names, Marvell. Taiwan has been an outstanding performer throughout the week. Also on Friday, we saw a massive pop in Las Vegas Sands and Wynn Resorts, and this is due to a change in regulations in Macau. The notable loser was JPMorgan, down over 6%, but look at the contrast here between GPM and WFC Wells Fargo. Wells Fargo was up over 3.5% on Friday, and that begs the question, did the big buffet, Warren Buffett, the greatest investor of all time, dump at the bottom, which is a classic mistake? It certainly appears so. Wells Fargo is outperforming now. Another overachiever on Friday is Netflix. Closed the day with gains of over 1%. We already talked about the price increases, and here are some more details for you. The monthly cost for the basic plan will go higher by $1 to about $9.99. The standard package will jump from $13.99 to $15.49. The premium plan will go from $17.99 to $19.99. We also have UNH. The health insurers, they got whacked this week due to Humana. And now we have another problem. All of them are saying, hey, Mr. President, we cannot meet the goal of supplying rapid tests for free by Saturday. Not going to happen. Give us a little bit of an advance notice here so we can get the job done. And this is not good for insurers, by the way. They're going to pay that extra cost. I mean, they're criminals anyways. They've been juicing us and overcharging us for years. So let them pay. Who cares? But here's the heat map for the week. And the theme is consistent. Financials were outperforming until Friday. Energy is the consistent outperformer plus value. And another weird outperformer is chips, with exception of NVIDIA and Broadcom. But all of them pretty much outperformed last week. You can see that clearly if we shift to the ETF heat map. Energy ETFs, the XOP, the XLE, are the outperformers for the week, along with the SOXL. This is the chip ETF. Look at the contrast of performance between value and growth. Growth was down, but value was not surging higher. Value was pretty much flat, yet outperforming growth. Gold had a great week. The GDX, along with certain international markets. The Brazilian ETF, the EWZ, I'm watching this name, I have calls, and it is one of the ETFs, the international ETFs, I'm looking to add to my portfolio this year. The EWZ was up by almost 7% last week alone. We're seeing emerging markets moving higher. We're seeing Chinese ETFs moving higher, yet European ETFs not performing so hot. So even though we have a lot of calls from Morgan Stanley and many other strategists who say go long European stocks because the valuations are more attractive, and they have quite a high forecast for European stocks performance this week. I say if US stocks go down, so will European stocks. Moving on to charts, starting with SPY, 30 minutes chart. What's going on here? Catching support from between 459, 461, and closing at the highs of the day. Is this bullish or bearish? The answer is it is bullish. We saw a reversal on Friday. The problem is you got to take it with a grain of salt. Number one, we have some short covering ahead of a long weekend. We have a shortened trading week this week. So yes, the SPY could recover, perhaps recapture 466 and a half for support, but the negativity is still here. The bears are still in charge. Here's a daily chart for the continuous contract for the SPY, the S&P 500. We are trading pretty much at the bear or bull to bear advantage line, which happens to be 4,657. The volume was higher than average on Friday, yet the momentum indicators remain negative. The bulls would say, look at this, we are making higher lows. This is good. The bears will counter and say, who cares, because this could be a reverse ABC pattern, which will take us down perhaps to breach the support of 4,549.5. Another way we can look at it, this is the bear's perspective. What if this, another formation of a bear flag, one giant bear flag, which will produce the same result as the reverse ABC pattern? What about the Qs? 30 minutes chart, what's going on here? Again, closing at the highs of the day, recapturing 379 as support. All of these are bullish activities. The problem is it came on Friday, combined with short covering ahead of the long holiday and the shortened trading week, so you have to take it with a grain of salt. But the bulls would argue, we're seeing a formation of a higher low. When we switch to the daily chart for the continuous contract and the Qs, the bearishness becomes more evident here. We are trading above 15,500. This is the good news for the bulls. We haven't lost that one yet. Another piece of good news for the bulls is the buying happened at higher than average volume, but that could be explained by short covering. Now, the bears would argue and counter by saying the momentum indicators remain negative, in negative divergence, both of them. And when we look at the weekly chart for the NASDAQ, the NDX, it doesn't look good here. It looks like we had a false breakout to the upside from the channel. We are now about to break to the downside from that channel, and that will mark the top in the NASDAQ. Perhaps the bull run that lasted for over a decade now. And here's a 30 minutes chart for the IWM, the Russell 2000, rebounding from 211 and closing at the highs of the day. Once again, bullish activities, but you gotta take it with a grain of salt for the reasons we discussed before. If the low volume continues and the path of least resistance takes place, we could go all the way to 218 and give it a shot at recapturing 218 as support. Dixie US dollar, what's going on here from a daily chart perspective? It is rebounding higher. The problem is, what if what we're seeing right now is an ABC pattern? We formed the A leg, now we're forming the B. Soon enough we'll be in the C leg, which will take us down all the way to around 93.75. If that happens, it will be good news for the old man gold. Gold is forming what it appears to be a bull flag pattern. And if it plays out, it could take us above the three amigos. Not only that, but above the sloping line of resistance that you see in yellow. And here it is, the daily chart for the 10-year yield. We talked about an ABC pattern. It appears that this is playing out. We had the A leg, the B leg all the way down to 1.7 for support, and now it's rebounding higher. Where will the C leg take us? The answer is to the moon, a minimum of 2%. And this is already playing out, by the way. Is the chart of the 10-year yield already overbought from an RSI and MACD perspective? Yes. But again, the fundamentals are so strong for the chart to go higher, all the way to 2%. It could happen. And if it does, it will be bad news for the TLT. The TLT bond bugs not doing so hot so as of late. This is a weekly chart. Bad candle, bad closing. It appears that the TLT will go down to at least 134.5. Here's a 4-hour chart for the VIX. Look at the MACD indicator. It remains positive. It is curling down, but we have yet to see red impressions on the histogram. The closing was bad for the VIX. It is below 20, perhaps indicating this path of least resistance rally we're about to have in anticipation of earnings this week. That could be the case, but you got to keep in mind that the MACD has yet to cross the negative territory, creating red impressions on the histogram. That will be the confirmation. What about the VXN, the VIX for the NASDAQ 4-hour chart? Quite different here. It dipped down, showing false negative readings before moving higher again. And the MACD remains positive, showing green impressions on the histogram, and therefore we have to anticipate that the VXN will move higher. Absent of confirmation in the 4-hour MACD indicator, we need to see strong red impressions on the histogram. That will be a conclusion that the run in the VXN is over, and perhaps the dip in the Qs, specifically the big cap names, the high multiple names, the oversold names, is worthy of buying in the short run. Here's a daily chart for Apple. What's going on here? Reclaiming 1.72.4 as support, and it is battling the sloping line of resistance once again. We have negative divergences on both the RSI, the MACD, so the bears remain in charge in Apple. What if this is an ABC pattern? We formed the A, we formed the B, we give it another shot at reclimbing the sloping line of resistance right now. If that fails, we're going to form the C leg all the way down to the channel. When we zoom in to a 30 minutes chart, you can see how accurate the sloping line of resistance/support is. As you can see, all of these bubbles are reactions to that line, and the latest reaction was a rejection from the line. Is it definitive? No, it's not. The chart, for all you know, could give it another shot at breaking that sloping line once again. The confirmation that this is a rejection will be closing below the previous low, which happens to be around 168. What about Tesla from an hourly chart perspective? What's going on here? Nothing is going on. It is still consolidating between 995, 1,090.5. The bulls would argue that we're seeing a higher low. The bears would argue, if you zoom out, this is still a bear flag formation. And if you followed my last video, it appears that we have a head and shoulder formation in Tesla and a giant bear flag. We'll see which one is going to play out, but for now, it's a toss-up. This chart has shown an insane amount of resiliency amidst the selling. It's a testament to the retail crowd who are not selling right now, because Tesla will be one of the last blocks to fall in this market. Tesla will not get crushed absent of margin calls. Margin calls will not happen until other pockets of the stock market get shot first. Moving on to Tulips, BTC, daily chart. What's going on here? Not looking good, folks. It appears that we still have a bottoming process. The chart is asking any buyers, any buyers, any buyers. I'm trying to hold the 42,000 here. If the buyers don't show up, it's going to flush down. It's going to flush down big, perhaps all the way down to 30,000. So the crypto maniacs, you better step up here. You better buy the dip in large volumes. Otherwise, this is going to flush down big. With that being said, we are still in a bottoming process so long as the chart is trading above 42,000. Lastly, what about AMC, an hourly chart? What's going on here? The apes got a beating on Friday, throughout the week, matter of fact, and now trading below 21. They lost the last support, and it is forming a bear flag formation. The only hope for the apes is that this will be a shortened trading week with low volume. The path of least resistance is higher, and AMC will catch that wave along with the rest of the market. Otherwise, boy, we're about to see an insane amount of pain here. Now, let's move on to the conclusion of this video. What do we have on the economic calendar this week? Tuesday, tomorrow, January 18th, we have the Empire State Manufacturing Index and the Home Builders Index. Wednesday, 19th, we have building permits and housing starts. Thursday, the 20th, the most important day, will have the initial jobless claims for the week, the Philly Manufacturing Index, existing home sales, and lastly on Friday, we have leading economic indicators. A lighter week than usual, so the surprise element is not here. You combine that with the path of least resistance is higher during shortened trading weeks, and you have a good setup for the bulls here. But we've seen before, Thanksgiving week, the week after Christmas, all of these were supposed to be good weeks for the bulls, but they turned out to be slaughter kind of weeks. So you got to be careful here, but the setup is good for the bulls from a micro perspective. The macro perspective remains negative. Folks, this is all I got for you for now, but be on the lookout for a video that I made over the weekend. I have not released it yet. I don't want it to cannibalize on this video. It's about insider selling. I will release that video around noon Eastern tomorrow while trading is happening, so you can watch it after the bell until the new episode is out. So be on the lookout for that video. But besides that, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.